So we now move on to the third and final reading in behavioral finance, which is behavioral finance and investment processes. This reading has 7 sections, and as we normally do, we will just run through these sections. As a high-level remark, the first few sections, so sections 2, 3, and 4, these build on what we've been talking about already. So these sections take the perspective of an individual investor, so any individual investor. So if you imagine that you are an investment advisor, sections 2, 3, and 4 deal with the people that you will be advising. And then sections 4, 5, and 6 then have to do with the industry, in the sense that then we look at biases that impact investment analysts. So if you are the analyst, we will look at the sorts of biases that analysts are exposed to, the sort of biases that might come up when you have investment committees making collective decisions, and then finally, what are the biases which impact overall market behavior. So simplistically, you can think of this reading as being divided in 2 parts. The introduction is short, and essentially the first part of the introduction repeats what has been said in the earlier 2 readings, that essentially behavioral finance challenges assumptions that individuals act rationally. So you know that by now. Investor classification based on behavioral characteristics. Now the point here is that in the earlier reading, what we tried to do is identify different behavioral biases. In this reading, what we'll try and do is create categories of investors. So look at the different kinds of investors and then look at what are the sorts of biases that different investors have. So this is a top-down approach, which I'll explain later, but concept is largely the same. It's just how we approach it and the perspective is a little different. And then essentially what we are going to look at throughout this reading is that behavioral factors impact advisor-client relationships. Why do behavioral factors impact this? Because when you are advising your client, the sort of psychological makeup of the client obviously impacts your relationship, and people who are better at understanding the psychological makeup of their clients will do a better job of advising them. Similarly, creating a portfolio for your client, as we've discussed earlier, obviously should take into account the psychological makeup of your client. Psychological factors, behavioral factors influence how committees make decisions. So if you understand those factors, then you can do a better job of maybe dealing with the potential biases. And then, as we've seen, psychological and behavioral factors impact market behavior. All right, so let's now get into section 2, the uses and limitations of classifying investors into types. The way we are going to do this is follow the sequence in the curriculum. We are first going to understand how we create different investor types, and then there'll be a segment at the end which deals with the challenges or limitations of doing so. The basic idea is that you can classify people based on their psychographic profile. So essentially, this is what psychologists do sometimes. They try to create different categories, put people in different categories and buckets based on their psychological makeup, and then try to predict what their behavior will be. Because people who exhibit certain psychological characteristics will behave in certain ways. Now, as you can imagine, this is not an exact science because people can behave unpredictably, but this is what we are going to do. The first thing we are going to look at is the most basic and probably one of the oldest psychographic profile models, which is called the B, B, and K model, based on the 3 folks, Bailard, Beale, and Kaiser, who came up with this model. So the idea is this: when you evaluate people, you evaluate them along 2 dimensions. One dimension is this careful versus impetuous direction. So on the left, we have people who are extremely careful. On the right, you have people who are impetuous, people who act suddenly, maybe emotionally, so it doesn't take much for them to maybe suddenly decide that they want to take all their money and invest it in a high-risk stock. That would be classified as impetuous. Careful would be somebody who has a lot of money and just is analyzing and analyzing before deciding what to do with it. So I'm sure you know people on either extreme. The other dimension is the confident versus the anxious. So as we go up, we have people who are more confident. As we come down, we have people who are anxious, nervous, and so on. So what you need to do is just stare at this picture and memorize these two dimensions. Okay, now there are two things we are going to do here. One is we are going to see what do we call people who fall in these four quadrants. So people who are confident and impetuous. Okay, so they are sure about what they want to do, but they are also emotional. They want to rush maybe into the next big investment. So you can imagine that their risk tolerance is relatively high. Okay, so they are not very risk averse. So these people are referred to as adventurers. So in your notes, I want you to also make a note of this. So these are people who are called adventurers. They are in this quadrant. What about people in the other extreme? So people who are anxious and careful. So extremely anxious, extremely careful. So these people are referred to as guardian. And then what about people who are careful and confident? So you need to remember this. Individualistic is what we call them. And finally, bottom right is called celebrity. And we are going to talk about these profiles just in a little more detail in a short while. And people who are in the middle are called straight arrow. Now just to help you remember this, other than, what do you need to remember here? You need to remember the two axes, so careful versus impetuous, confident, anxious, so you need to remember that, and you need to remember these four areas. Now, I think it would be useful in terms of your remembering this to figure out where you fall. So I want each one of you to do a quick exercise to see where you stand. Like I would put myself somewhere over here. All right, you need to figure out where you are. So do this. If you're watching the video, pause and just mark where you stand. All right, so this was your most basic model. Now, what I want you to do is, and we are going to see this in Exhibit 2, but to help you remember this, the four types of profiles that we came up with. So what are the key points that come to mind with regards to an adventurer? The first thing, if you see something like this in your case study on the exam, the moment you see adventurer, where on the axis is adventurer? So the adventurer, immediately you put the top right, and then what was this axis over here? So this was the, no, adventure, there was nothing, there was no, impetuous, exactly. So impetuous, and what about top over here? Confident. So impetuous, confident, adventurer. Now, what sort of investments do you think a person like this will do? So he'll be high risk. You think he'll be diversified? Probably not. So undiversified. Now here is a classic example. Many years ago, I used to play squash in the US, and the reason I give this example is one of the guys I played with, he had never invested in stocks before, but this was the internet bubble, internet craze. So somebody advised him that there is this technology company called V. and I still remember that name. So he got all excited and put all his money into that .com technology company. He subsequently lost everything, but that was an example of being impetuous and being super confident. So you have lots of people like that. Do you think they are easy to advise? Yeah, these people are not easy to advise. They are acting, they are confident, so they think they know what they're doing. And we are going to talk later about the biases. And they are impetuous, so they act based on emotion. So these are the hardest people to deal with. People who know what they want, who think they know a lot, are confident and are impetuous. Okay, what about the celebrity? Where was this category? So the celebrity was bottom right. So they are also impetuous. And then what was this dimension? So this was the anxious dimension. And what I want you to do here is read exhibit 2, because this is really, it's a short exhibit and it's a good indication of what you need to know. And it essentially summarizes the most important points. So I'm going to read this with you. Let's do the celebrity. So celebrities like to be the center of attention. Is that hard to believe? Not really. They may hold opinions about some things, but to a certain extent recognize their limitations and may be willing to seek and take advice about investing. So generally they are easier to deal with relative to adventurers. All right, next, individualist. There was this category. So this was in the top left. We had confident over here and careful over here. So individualists are independent and confident, which may be reflected in their choice of employment. They like to make their own decisions, but only after careful analysis. They are pleasant to advise because they will listen and process information rationally. Okay, so like I mentioned, I'm probably in here. So I like to make my own decisions. I don't like to do what bosses tell me to do. So guess what? I am independently employed. All right. Next is guardian. So where do these guys fall? So they are in the bottom left. So they are careful and they are also anxious. So these people probably need a lot of hand holding. So let's read about them. The guardians are cautious and concerned about the future. As people age and approach retirement, they may become guardians. They are concerned about protecting their assets and may seek advice from those they perceive as being more knowledgeable than themselves. Okay, so fairly straightforward. And who are these straight arrows? So these are down the middle. So from a behavioral finance perspective, they are the least interesting. Why? Because these probably will be the people who act most rationally. All right. So I hope you get the point. You need to understand this framework and you need to understand or at least know that exhibit fairly well. Okay, next. So now we move on to what's called the behavioral alpha approach, which is a top-down approach to bias identification. Now, what do I mean by top-down? In the previous reading, what did we do? What we did was we looked at a whole laundry list of biases. That here are all the cognitive biases, here are emotional biases, and then we asked lots of questions to determine whether a given person exhibits a certain bias or not. So that was a bottom-up approach to bias identification, where you look at all biases and try to figure out whether a given person exhibits any of those biases. This behavioral alpha approach takes a top-down approach, where we basically try to categorize a person based on his psychographic profile. And then we say, okay, if a person is in this category, in a certain category, which is called a BIT, a behavioral investor type, then we say people in so-and-so category typically exhibit so-and-so biases. And then we validate whether those biases indeed exist. So that's why this is called a top-down approach to bias identification. You need to understand this process. It's a very simple process. The first part is coming up roughly with that psychographic profile, the type of investor you are dealing with. How do you think you do that? You speak to the client, you interview the client, you ask questions, and then you identify whether the client has active traits or passive traits. Is the client a go-getter? Does he like to go get things done? Does he like to do his own investments? Does he want to make a lot of money fast? Or is he just the sit-back sort, the passive sort, who is not in a big hurry to invest money or get a huge return? So you ask questions to identify active versus passive traits, and obviously you ask questions to determine risk tolerance. Generally, active people who are identified as having active traits will tend to have a high risk tolerance or low risk tolerance, generally speaking. Higher risk tolerance, or they would be relatively less risk averse, and the other way for passive traits. But all these are on a scale. It's not binary. You are not active versus passive, you might be somewhere in the middle, and even risk tolerance is on a scale. Now, to understand how we determine where a client is on the active versus passive scale or on the risk tolerance scale, we ask questions. And what you should do right now is read the 9 questions. These are really simple, quick questions, so highlight them, and I'll pause here for a minute while you read these questions, because they give you a good indication of how we determine this information. As a memory tool, if you answer these questions for yourself, that will help you sort of register this information better. Okay, now notice the following. If you look at step 2 and exhibit 3, this says plot investor on active passive scale and risk tolerance scale. So the way you can look at this is as follows. One scale is the active to passive. If most of the answers were A's, then where would you be? Would you be more on the active side or the passive side? So looking at these questions, if most of the answers are A, then you would be on the active side. And depending again on how you answer, typically people on the active side, if you also then look at the risk tolerance, so if risk tolerance is low over here and high over here, so actually I should do it like the curriculum. So curriculum has active on the right and passive on the left. So people who might fall here as being relatively active will also have relatively high risk tolerance. But again, this is not black and white, it's not binary, it's over a range, it's a spectrum. So you've understood part 1 where you interview the client. Next is plot the investor on an active passive scale and risk tolerance, that's exhibit 3. And then you test for behavioral biases. The point is this, actually, we are going to build exhibit 4, which will help us understand what to do. The big picture is as follows, that once you have categorized your client, let's say as being active and risk tolerance high, then as we'll see in exhibit 4 in a minute, for people of that psychographic profile, there are some typical behavioral biases that they exhibit. So we just take those behavioral biases as a given, or then we test whether they indeed have those biases. We should test whether they indeed have those biases. So that's step 3. And then we finally classify investor into a behavioral investment type. These are called bits, and there are 4 behavioral investment types that we are going to discuss now. It is useful for us to actually build exhibit 4, and this will help us remember this exhibit. I think it's the most important exhibit in this whole section. So as I mentioned earlier, your general type can range from passive all the way to active. How do we determine this? Through the questions. And then risk tolerance again is going to be on a range of low to high. If somebody is classified as active, then the risk tolerance typically would be high to medium. And if somebody is classified as passive, then the risk tolerance would typically be low to medium. Okay, now for somebody who is classified as passive and risk tolerance is low, the general investment style that we would use for them is conservative. Does this make sense? So they are very passive, don't want to take risks, so obviously you will do a conservative investment for them. What is their bias type? Now typically people in this category tend to mostly have emotional biases. Now the reason we want to classify this is that you might recall from our earlier reading that how you deal with people depends on whether their biases are largely emotional or largely cognitive. With people who have more cognitive biases, you might use more education and so on. With people who have emotional biases, you use a slightly different strategy. Okay, what does BIT stand for? It stands for behavioral investor type. So this behavioral investor type is called a passive preserver, and you need to remember this. typically passive preservers exhibit the following emotional biases. And actually, why don't you try and guess? So of the emotional biases that you studied in the previous reading, what are the sorts of biases that they exhibit? Any ideas? So there will be loss aversion. So actually, you are probably looking at it right now, so you are not really guessing. They exhibit typically what's called endowment bias, loss aversion bias, status quo bias, and regret aversion. And from a cognitive perspective, there are a few also. So mental accounting, and then anchoring and adjustment. So these are some of the biases that they might exhibit. But do we just take this as a given, or do we still need to test for this? We still need to test for it. Then the next is this category. What is this category? General type is still passive, but risk tolerance is medium. So the investment style here would be moderate. The bias type is generally or primarily cognitive. And this behavioral investor type is called a friendly follower. Emotional biases, not very many. The only one that we are concerned about is regret aversion. And the cognitive bias is, there are more cognitive biases here. So availability bias. What do you remember what this was? Availability bias? Yeah, so they rely heavily on information that comes to mind more easily. Outcomes that come to mind more easily are given higher probabilities. The other is hindsight bias. And finally, framing. Next category is growth. So this stands for, this is where your investor is active, and risk tolerance is again roughly medium, less than high. So what are these? The biases here are also cognitive. You'll notice that in the middle you have people who have more cognitive biases, and on the extremes we will see emotional biases. These people are called independent individualists. So II. They've decided to name all these people in a way that makes it easier to remember. So what's this? Independent individualists. And the emotional biases are relatively few, so they tend to exhibit overconfidence and self-attribution. And the cognitive biases are conservatism, availability, confirmation, and representativeness. And we'll see this in a little more detail later. So the final category is the most dangerous one, where you have people who are very active and the risk tolerance is very high. So typically for them, you can have a relatively aggressive investment style. What's the bias? Do you think it's primarily emotional or primarily cognitive? So these people tend to be more emotional. The BIT here is called active accumulator. And does it surprise you that these people tend to be overconfident and they think they have more control, self-control than they actually do? And cognitive biases, though, the only one that's mentioned is illusion of control. Okay, I've gone through this. I know it's not very hard, but I just want to emphasize that it's very important. Okay, now Exhibit 5 is a self-study. You will notice that this is actually a summary of the process. So we ask, is a client, if you look at it right now, is the client active or passive? And then you basically are following, okay, he's passive, then you do this. If he's active, then you have another flow chart. So the only thing I want to highlight is, if you look at the bottom, it points out that a friendly follower could have some independent individualist traits, and independent individualist could have some friendly follower traits. What's this emphasizing? It's simply emphasizing that this is not like hard and fast buckets. This is a spectrum. So people can be in one bucket but exhibit traits from another bucket. So I think this is also important. Just read it. And then the next few pages simply give you the important points for each of the 4 categories that we came up with. And what I've tried to do here is summarize the most important points from each of those segments. So for a passive preserver, there is an emphasis on financial security and preserving wealth, focus on taking care of future generations. These people tend to be worriers, they are slow to change. Now, before I ask you to remind me of the common biases, here is how you can remember this. Now, I am going to do some big time stereotyping here, but this might sound strange, but this is what I have observed. If you look at middle class in, say, places like India and Pakistan, and you look at the moms in a middle class family, what are they generally concerned with? Are they concerned with get rich quick? Or are they concerned with their kids getting good education, making sure there is enough money saved so that the future generations get their education and so on? So I would typically put people in that category. And for people in the US, the stereotypical example is a Jewish mom. So you might not believe this, but there are lots of similarities between Jewish moms and moms in middle class Pakistan. So I would, roughly speaking, put them in the passive preserver category. Okay. So they tend to worry, slow to change. So what do you think are the common biases exhibited by this category? So we just saw this. So are they, first of all, is it more emotional or more cognitive? So it's more emotional. And what are the emotional biases? Loss aversion, status quo, regret aversion, and so on. Okay, so you need to remember this from the previous slide. Now, how do you advise these people? Do you talk to them in terms of Sharpe ratios and so on? Probably not. That would not make sense. They are generally difficult to advise because they are driven by emotion. So you need to focus on what money will accomplish. So focus on, you need to save, because this saving will help your kid go to college, which will help secure his future, and so on. So obviously the way you advise these people is based on, as in you use language and examples that they can relate to given their psychographic profile, given their psychological makeup. So that's passive preserver. Next, friendly followers. So I'm sure you can imagine this. They want to be in the latest and most popular investments. So if they read that commodities are doing really well these days, they want to invest in commodities without quite realizing what are the risks involved with investing in commodities. They often overestimate their risk tolerance. Now, what are the common biases of friendly followers? Do you remember that? Is it more cognitive or more emotional? So here it was more cognitive. The biases were availability, hindsight, framing. Now, what do you have to think about when you advise these friendly followers? So whenever there is more cognitive bias, education helps. And if you can, these are generally relatively smart people, so you encourage them to understand the implications of their investment options. So if they are big time into commodities, because commodities are hot these days, what are the sorts of things you will tell them? Like, what are the risks associated with commodities? They don't generate cash flows, for example. So you just help them understand what are the limitations of the investments that maybe they are inclined towards. Okay, next, independent individualist. So these are people who are strong-willed, independent, they might enjoy investing. What were their biases? Again, they were mostly cognitive, so conservatism, availability, representativeness, etc. What do you need to think about when you advise these folks? Okay, so these people generally listen to advice when presented in a way that respects their intelligence. So the point is, when you advise these people, you need to respect the fact that they are sensible, they know what they are doing. Now here is an example from my past. So many years ago, I decided that my experiment with investing too much in Oracle stock had not quite worked. So I went to an investment advisor. And he started treating me as if I don't know anything. And obviously that totally turned me off. I listened to him and then I did what I wanted to do. So he got very concerned that I'm giving you all this advice and then you go around and do whatever you want to do. Okay, that probably was because he didn't quite understand my situation well enough, and then maybe he also did not have enough respect for my intelligence. So that advice process did not work too well. In any case, also in a sensible way, educating your clients and making sure they understand the benefits of diversification and so on obviously helps. The final category, the toughest one probably, active accumulator. So these are the most aggressive types. They tend to be entrepreneurial, they tend to make decisions quickly. Chances are that their portfolio turnover is very high. What's the issue with this? What's the issue with high portfolio turnover? Yeah, generally there'll be high transaction costs that will drag down your net returns. What are the biases these people exhibit? The biggest one is going to be overconfidence, control, etc. So these people tend to be hands-on, or they like to be hands-on. So what do you do as an advisor? So can you imagine that these are the hardest people to advise? So you have to work really hard to win their trust and respect. So they will only listen to you if they trust you and respect you. So you need to prove to them that you have the ability to make wise decisions, objective decisions, long-term decisions, and you need to be able to communicate that in a way that they can understand and relate to. Okay, so what I have done here is essentially summarize what I think are the most important points. Obviously you can read the curriculum, but at the very least you need to know this stuff. We've essentially categorized into these 4 buckets, but as happens across the curriculum, you might remember this from level 1 and level 2. Whenever you are presented with something, there's always going to be a subsection or a section that says, okay, what are the limitations of this approach? And the same applies here. While we say that most people exhibit largely cognitive or emotional biases, but there are lots of people who exhibit both cognitive and emotional biases. It's not a either or scenario. People can exhibit characteristics of multiple investor types. So that happens too. I don't think it is overly necessary to understand all the details here, because I think these descriptions are self-evident. Behavioral changes. So one obvious example is as people grow older, obviously their psychological profile and their behavior changes. Unique treatment, even though you might have identified somebody in a given bucket, does that mean that everybody in the bucket is the same? Not quite. So there still needs to be some unique treatment. And no matter what you do, people will from time to time act irrational and they will be unpredictable. Why? Because we all know this, we are all human beings. If there's a stresses at home, that causes people to act in strange ways. So until you know what's happening in the personal life of someone, it might seem that he's acting totally crazy, but there might be a reason why the person is acting irrationally or unpredictably. So bottom line is we need to recognize that we are dealing with human beings. Okay, now moving on to section 3, how behavioral factors affect client-advisor relations. And the way I've structured this is a relatively short section. I've taken each section and made this one part of a table. So each of these little sections captures some aspect of a client-advisor relationship. So all I think you really need to do here is for each aspect, just understand what are the couple of behavioral considerations that you keep in mind. When you are formulating the financial goals of your client, so in other words, you are helping create the IPS, what should you do? What are the behavioral considerations? The core point is you should understand the psychology of your client. You should understand the emotions. So essentially, the point is you should try to understand the psychographic profile of your client as you create the IPS. I would say those are the most important points in the first step. What about as an advisor, you want to maintain a consistent approach. So from a behavioral consideration perspective, if you understand the client well, understand his psychology well before you present advice, obviously that's what make sense here. So you have a consistent approach, but you need to basically understand your client. And what do we mean by understand? Essentially, it means understand the way, basically get in his head, understand how he thinks, how his emotions work, and so on. Next point is investing as the client expects. Now, obviously, in almost any discipline, there is this concept of expectations management. So you want to understand what your client expects, and you also want to have a situation where what you are delivering meets the client's expectations. So if you understand the client's psychology, obviously then it is easier to understand what he expects, and then it is also easier to deliver what he expects. Now here is another unusual example. I'm sure all of you have met a doctor at some point, a general practitioner. So you have some issues, you go meet a doctor. Now, when a doctor interacts with you, in essence, he's really doing two things. One is he's trying to figure out what's physically wrong with you, and the other and then he prescribes the appropriate medicines and so on. But a good doctor will also talk to you in a way to make you more comfortable. And to be able to do that, he should understand your psychology, how you behave and how you think. Do you see this analogy in an investment advisory scenario also? So what is analogous to prescribing the medicines? That part is analogous to the sorts of returns and risk, the sort of returns or results that you are delivering. But at the same time, I'll just give you an example in this context. Let's say that the market is down by 20% and the investments that you help pick are only down 15%. Do you think your client is happy or unhappy? An average client might be unhappy because he's looking at a 15% loss. But how you then explain that to the client, knowing his psychological makeup, is extremely important in terms of your relationship with the client and keeping the client happy and giving the client what he expects. So that's the main point here. And essentially ensuring mutual benefit, this is a similar point, that you want to understand what the client is thinking, and as long as you can keep the client happy, then that is beneficial for you as well as the client. So I don't think this is overly testable, this whole section 3. There are no examples in here, but we have covered the main points. Then the last part of section 3.5 is the limitations of traditional risk tolerance questionnaires. I think the curriculum has included this because all major investment advisory firms have lots of investment advisors working for them, and firms like to standardize. So you can imagine that all large firms will have the standard questionnaire which all investment advisors are supposed to use. But what is being pointed out here is, while that's a good thing to do, there should be standardization, but we need to recognize the limitations of those questionnaires. So those questionnaires might ignore behavioral biases. They might be, so questions are asked in a certain way. So that automatically creates some potential framing bias, because how a question is asked and how the client interprets those questions obviously has an impact on how he answers. So again, I don't think this is overly testable, as long as you recognize that while using questionnaires is important and it should be done, but it's not a foolproof mechanism of figuring out the client's situation. How do behavioral factors affect portfolio construction? A few basic points here. Inertia and default. So what do you think this means? What does inertia mean? Does anybody know? So, yeah, if you remember from, I don't know how many of you have studied physics, but the basic definition in physics was that any object that is at rest will stay at rest until you apply a force, and an object that is moving at a steady speed will keep moving at a steady speed until you apply a force. Okay, now what is the analogy in a financial context? People also have inertia. So if people have, if somebody is sitting on cash and has not invested it, what does inertia say? Inertia says that money will just keep sitting and he will not invest. Or if he has it invested in a certain form, it will just stay invested in that form. And default simply refers to that when people have options, most likely they will just select the default option, no matter what it is. Okay, now, what's a possible problem with, say, inertia? A potential problem is when you are young, what is the appropriate mix of, say, stocks and bonds? The appropriate risk might be higher percent equity and few bonds, because if you have a good job, the job is covering your expenses and you are saving for retirement, your retirement is 35 years away, it makes sense to have most of your savings in stocks. As you get older and you approach retirement, does that same allocation make sense, or should you then be moving towards safer investments? You should be. But if you have this inertia impact, what's that doing? The inertia impact or the inertia effect will say that you keep with your old allocation. So we need to recognize this, and we need to consciously change our allocation based on our circumstances. So one possible response is what's called a target date fund, which says that, okay, when you set up your fund, you recognize when you are retiring, and as you get close to retirement, then you start shifting your allocation towards safer investments. And I'm not going to do this here, but a good example of this is given so read example 1 for this. It's a quick short example and essentially highlights what I just talked about. Another behavioral factor which impacts portfolio construction is naive diversification. And here people use simple heuristics and framing bias to do something which they think is diversification. And the classic example given that you need to be aware of is this 1/n diversification. And I've seen examples of this. Lots of large companies in the US allow you to save for retirement through what's called a defined contribution plan. In a defined contribution plan, the company will tell you that here are 5 possible investment vehicles, for example. So these might be 5 different mutual funds. One might be a high growth stock fund. Another might be a value fund, just as an example. So you might have 5 different options given to you. Some people use the simple heuristic that says that if I am investing or saving 100, I basically put in equal money. So I put 20, 20, 20 just across all, and they think they are diversified. Now, what's the problem with that? They aren't doing any analysis of what are the correlations across all these investments. They aren't thinking about their current state. So, for example, if they have lots of excess cash and they are retiring after 35 years, then it might make more sense to be in the small market cap stocks and large market cap stocks alone. If they are close to retirement, it might make sense to have another asset allocation. So they are ignoring all these factors. So I've seen this several times, this 1/n diversification. You just need to remember that it is an example of naive diversification that happens because of using simple heuristics and a framing bias. Okay, another issue is company stock. Now, I gave you this example earlier where I've done this and lots of people do this, where people, when they are saving for retirement or saving in general, people tend to buy their own company shares. Why? Because that's what they are familiar with. Familiarity leads to confidence effects. There is a naive extrapolation of past returns. So if my company has done really well over the last 3 years, what is a naive extrapolation? It is that this company will continue to do well. Framing and status quo effect of matching contributions. If the company says that when you put money in any investment, we are going to match that by giving you some company stock. When the company says that they are giving you company stock, then people tend to invest even more in company stock. There might be loyalty effects. So I work for this company, I love this company, I want to buy this company stock. Okay, so is that emotional or is that rational? That's emotional. And then actually a rational reason might be that the company is actually giving you a financial incentive. So if the company is saying that if you buy company stock, we'll give you a discount. So there might actually be rational reasons for doing so. Excessive trading, why do you think this happens? So here is an issue that people often face. When you buy stocks and the stock price is up, what might people do? People might just lock in a profit because of the loss aversion bias that they don't want later the stock to go down. So what will that do? Excessive trading is going to put a drag on your returns. So anyway, so that's, I think, the major point here. Excessive trading can also be driven by overconfidence. So you are confident that, okay, this stock has reached a certain price and you are sure about your analysis and research and you just sell it off. And the final sort of bias that we'll talk about here is home bias. What do you think this means? Yeah, this is like a familiarity. People, it's been shown around the world that people like to put more money in stocks from their home country. So people in France tend to buy mostly French stocks, people in Germany tend to buy German stocks, people in the US tend to buy US stocks. This used to be a lot more, but now it's becoming less and less, though this bias still exists. What do you think would be the more rational thing to do? If you are in an integrated global financial market, it makes sense to have your portfolio diversified across multiple regions. Okay, the final point in this section, in section 4, is behavioral portfolio theory. Now, we covered this briefly, or we covered this actually in more detail in the previous reading. So I'll very quickly just describe this again. What is your classic mean variance portfolio? So in your classic mean variance portfolio, you might have different assets. So you might put money in cash, in stocks, in bonds, in commodities. And then you worry about all these different correlations between all the different asset classes, and you try to come up with an allocation that maximizes your return for a given level of risk. Whereas the classic behavioral model does what? This essentially creates layers, where you have one layer of low risk investments that maybe deals with your regular expenditures, and then we talked about this moderate risk and high risk. What was the issue here? The issue was that even though we are putting money in different layers and buckets, we are not thinking about the correlations across layers, but it still sort of deals with the framing bias and the bias that people have to allocate money in different buckets and say, okay, this money I'm going to use for this purpose, this other category of money I'll use for another purpose. Again, I think this material is covered in more rigor in the previous reading, so we don't need to get deep into this.